Welcome back to the Anton Stetner podcast. Today we are going to talk about the massive tug-of-war that we're seeing happening right in front of us between President Trump, the Federal Reserve, and the rest of the world. And what I want to talk about today is this idea of President Trump is demanding, insisting, wanting, needing lower interest rates for his plan. So we have that on one side. We've got Jerome Powell on the other side, being the Fed is independent, we're not going to bow, we're not going to give in. And so you've got this tug-of-war that's going on, all while we have tariffs brewing in the background. We have economic uncertainty. What I want to do is I want to dig into some of this data today. I want to talk through this. I want to talk about how it relates to our economy, and then, as always, how it relates to real estate and your money. The main topics we're going to go over is how Trump is waging a war on interest rates, how his tariffs are possibly giving us the absolute opposite effect of what he wants, how the Fed is working to maintain their independence, and what their current plan is and what they're telegraphing to us, where the 10-year Treasury is headed, because that's what controls all of our debt, and most importantly, like I said, what this means for you, your real estate, and your money. So we know Trump's objective is to get rates down. Why is he so bent on getting rates down? And why is he just not subtle about it? I mean, he's actually downright demanding. So in January at the World Economic Forum, he said, and I'm quoting here, this is literally a quote, "I would demand that interest rates drop immediately, and rates should be dropping all over the world." That's not a suggestion. That's not a request. That's a demand. And the Fed then decided yesterday, at the time of this recording, that they were going to leave rates unchanged. This morning, President Trump goes on to one of his favorite platforms. You know, he's like on Twitter or Truth Social. This one was on Truth Social. And he said, and you could kind of hear the frustration, arguing with the Fed out loud, "We will be much all capital, better, cutting rates all capital," as the U.S. tariffs start to transition their way into the economy. So Trump is going back to one of his old tactics. I don't like this, where he's starting to bully Jerome Powell into lowering rates. He's trying to publicly ridicule him into lowering his rates. And why is he so obsessed with this idea of lowering rates? One, it makes everything cheaper. So if we can make it cheaper for the consumer can feel less pain. Auto debt gets cheaper. Student loan debt gets cheaper. Credit card debt gets cheaper. For our industry, mortgages get cheaper. Business credit gets cheaper. Second, lower rates tend to boost the stock market, which stimulates the economy. And historically, that was one of his scorecards, his things that he was measuring his success by. But in this last term, notice how he's not mentioning the stock market as much. He's less concerned about Wall Street, and he's going after Main Street. Third, we believe, and he believes, that lower rates could offset the negative effects of the tariff policies that they're trying to implement. And this is kind of a multi-pronged approach that he's really working on. Using tariffs as a fiscal policy tool to bring revenue into the United States and to get trade in balance, to bring manufacturing home, to incentivize bringing manufacturing home here to the U.S. And he's been making key appointments to the Federal Reserve and also working on implementing his tax cuts. The irony is, though, that many economists believe that these tariffs, and I'm one of them, I'm not an economist, but I believe this too, these tariffs are creating inflationary pressure, which makes it harder for the Fed to cut rates. You actually seen this in inflation expectations. Inflation expectations have been rising. And we'll talk about that more in the next section. I want to say thank you to all of our listeners who always join us. And hit that like button, hit that subscribe button. And if you're listening to this on audio, we could use more positive ratings on audio. So section 2, let's talk about the Federal Reserve's response to what President Trump is saying. What did the Federal Reserve do? The Federal Reserve started immediately taking a firm stance, both pre his presidency and then during his presidency. Jerome Powell has made it abundantly clear that he will not let policy politics dictate the actions at the Federal Reserve, the central bank. And they're not going to move towards the political pressure. So they just had their meeting yesterday, and they decided to keep rates unchanged. They also released the FOMC meeting minutes. And they talk about their forward projections. There was lots of speculation about the Fed going to maybe one rate cut in the future instead of the two that we're currently, or maybe going to three, depending on how they felt about the economy. They kept it at two, and I mentioned this on my stories and yesterday. The Fed tiptoed around the data. They said some of the inflation expectation data, we're just going to ignore it. The slowing down of the economy is probably outweighing that, so it's a bit of a wash. We're just going to wait and see. But the thing Jerome Powell said, and he said it over and over again, was uncertainty, uncertainty, uncertainty. So this tariff talk, this moving around of the cheese, of what's actually happening, is creating a lot of uncertainty in the market, and it's causing the Fed just to pause and wait. He said, and I quote, "We need to see how these tariffs play out before we make any moves." It's pretty clear the Federal Reserve is going to wait. My concern here, though, is I think the Federal Reserve is going to end up waiting a little bit too long. They're going to wait too long to react, and if they do that, that could start to slide us into a recession. I asked questions on some social media earlier today. Hey, where do you feel about rates? What do you feel about the economy? Where do you think we are going? And one of the commenters did say back, they believe we've actually already been in a recession over the last 2 years, but it was covered up with the government spending and the hiring. That's why the average person felt so pinched. And that comment really resonated with me, that the average person feels very pinched, that our economy has actually already been slowing down. It started slowing down during the Biden administration, but it was propped up with the excessive spending and government hiring, and now we're starting to see some of that come to fruition. As these inflation expectations rise, though, it basically puts roadblocks in front of us that will prevent the Federal Reserve from cutting rates in the future. And heaven forbid, this puts us on the road to what if inflation is rising while the economy is slowing. That could head us into the dreaded idea of stagflation. So I'm still, like usual, I'm cautiously optimistic, but we got to really start paying attention to some of these economic indicators. Lower growth, sticky inflation, possible stagflation. But see, the Fed did give us a little nugget. They can say things and do things. So always watch what people are doing. Watch where the money is going, because that always tells us a better story than what they're saying. What they did decide to do is they decided to slow down their Treasury securities runoff. So it's called quantitative tightening. The Federal Reserve was selling off their balance sheet, putting more Treasuries into the open market, which keeps rates higher. They decided to drop that from $25 billion a month to $5 billion a month. You can basically say that quantitative tightening is done. That eases pressure on the 10-year because there's less supply with the same amount of demand being there. That should help rates to come down. The big one that would help rates to come down even further, though, is if they were to pause the selling off of their mortgage-backed securities. Because as those mortgage-backed securities directly enter the market, that's competition in that market, which then affects rates a little bit more directly, especially in real estate. Once again, that's one of the things we're always watching. It affects them more directly than just the 10-year. So understand the Fed is in the middle of walking this crazy tightrope. A slowing economy, rising inflation expectations, massive political pressure, and a rising dollar while the administration wants to bring manufacturing home. So how did the market respond? What does this look like? The 10-year Treasury actually responded positively to this. It went down a little bit. The stock market went up a little bit. But you have to realize that the 10-year Treasury has been trending in a downward direction. So we were low right before the election. then, we called it the Trump trade. The 10-year Treasury started trending up because of inflation fears. Now Trump's in office. When he got in January, it was basically at a high of 4.8. And right now we're sitting around 4.22. So we are trending in the right direction. It's just not trending there as fast as President Trump wants. It's not trending there as fast as I want as a real estate agent, a real estate investor. I told a lot of you that we just had to refi some commercial debt, and that commercial debt is super expensive. One of the reasons they're trying to get the 10-year Treasury down is the federal government has to refinance like $6 or $9 trillion worth of debt that's coming right now. And the U.S. would save an unbelievable amount of money if that debt is refinanced at lower rates. And the economy would start to pick up if rates were lower, which allows them to pull these tax cuts through. What am I thinking in regards to real estate? What I'm thinking in regards to real estate is what's already showing up in the data. Existing home sales was predicted to come out at 3.95 million. It's where all the economists were. A lot of doomers were even like, oh, it's going to come in worse because, the economy sucks. And I was like, maybe I'm biased because we're here in the Seattle Metro, but I feel like the market's on fire right now. We're super busy. And it blew expectations out of the water. The existing home sale number came in this morning at 4.26 million. Way higher than expected. Of course, one data point does not make a trend. We're going to have to wait to see what's happening. But I can tell you for us here in the Seattle Metro, that's what we're experiencing. The market's on fire. We're busy, busy, busy. If it's priced correctly, it's selling. We're still getting good deals for our real estate investors. So to flip it back, the 10-year is still sitting there. And it's not quite straightforward because we're on a less aggressive path to rate cuts. You've got yields potentially increasing. You've got Trump policies that are pushing up tariffs. And so what the market is doing is it's really flip-flopping, where people are saying, we want to know what's happening. But like we talked about on that previous episode, and you can go watch this, I believe the administration is purposefully slowing down the economy and possibly trying to push us into a mild recession so we can get rates down, so we can refinance the debt at lower rates, so that we can get business and the economy moving and help the middle class with their rates. And ultimately, I don't know who's going to win this tug of war. I'm just going to keep bringing you the data. I want you to be paying attention to it with me, and we're going to remain cautiously optimistic. Let's go into tariffs now. So the tariff factor is this gigantic elephant in the room. Everyone knows it's there, but we don't know what the elephant's doing. And the administration is kind of unclear. They want one thing one day, and then it changes. And that's why I believe they're using it to slow the economy down, because you can see the stock market trimming itself down a little bit. And we kind of need to do that. We need to trim down some of our asset prices, which includes housing, even though I don't think it's going to happen on the housing side. All assets have gone on a massive rip due to the massive money printing that's been happening. The problem is if you didn't have assets, you didn't get to go on that ride with the asset owners, and you just got hurt. When you slap a tariff on any good that you're going to import, it causes less people to buy it because it's more expensive. Now, whether the business is paying it or the consumer is paying it, it doesn't matter. At the end of the day, it's just more expensive. That's not economic theory. That is a fact. So tariffs are creating these global ripples through the market where Canada has expressed problems with it. Mexico has expressed problems with it. The European Union has expressed problems with it. And it's causing their currencies to fluctuate and our currency to go up. But the problem is our currency goes up, it gets harder to bring American jobs home and create manufacturing here. So it's a very interesting tap dance that we have going on. So what's happening on the economic side? What's our outlook? What are recession risks? I will tell you, when you go look at the bookies, when you go look at the market, you can see recession risks are rising right in front of us right now. You can see that there are indicators that the economy is slowing. And we mentioned the Atlanta Fed GDP. Those numbers went massively negative. Now, understand the Atlanta Fed GDP is one of those surveys that can respond very quickly to data and change very quickly based on sentiment. The Fed's projection and the summary of economic projections of inflation is 2.7. So that's rising. Inflation, it looks like it could be rising, but it's not necessarily rising. It's just people's perception. The problem with inflation is if people believe things are going to be more expensive, they automatically become more expensive. It's this self-fulfilling prophecy. The labor market is still relatively tight with unemployment at about 4.1 and the Fed projecting 4.4 by the end of the year. But you see unemployment rising, you see jobless claims rising, you see this showing up in the data. So to put it simply, what we're looking at is we're looking at slower growth. We're looking at some persistent and sticky inflation and a slowing down job market. So is this all doom and gloom? It sounds a little doom and gloom, but I'm going to tell you from my perspective in real estate, this is not doom and gloom. It's actually going to end up helping us. You've got major financial institutions, though, like Goldman Sachs and JP Morgan, have increased their recession possibilities. So in this economic tug of war, who is the winner? Well, just like Jerome Powell, we're going to have to wait and see based on the totality of the data. The Fed's going to continue to battle inflation, but I believe rates are going to keep trending down. I believe they're going to keep moving in the right direction, and all you have to do is go look at the 10-year, look at the channel and the direction it's heading, and you'll see what I'm talking about. I do believe we've beat inflation, and tariffs are not going to be as inflationary as people believe. One of the reasons I mentioned that data point very simply is I've gone looking for economic data to show that tariffs are massively inflationary. There is some inflation, but not massive. And Jerome Powell may have stuck his foot in his mouth again. He said, well, inflation expectations are transitory. I'm like, bro, you said inflation was transitory. Don't use the word transitory ever again. That one's going to be put in your memoirs. Like, drop the transitory word. But I do agree with him. I think they're overblown. And when you go in and look at some of these surveys about inflation expectations, there was one that I recently read where it showed the inflation expectations of a Democrat versus a Republican. And because the Democrat power is not in party, their inflation expectations were like 65, 70%, versus the Republican expectations of inflation were like in the 25, 30%. So it really depends on what side of the coin that you're on right now. Your key takeaway: stay nimble. Get a little bit of cash. Hunt for deals. When the economies are in states of transition like this, this creates deals and opportunity. I met with individuals, just yesterday who were considering owner financing their investment property and selling their investment property because they wanted to run away and be an expat and just ignore the noise that's happening here. That deal ultimately did not come together, but opportunities present itself when there are economic uncertainties, when the data is not really clear. But the data is very clear on one thing in relation to real estate. We have a massive lack of supply. Building homes is not getting any easier. Developing is not getting easier. Therefore, the lack of supply is going to increase prices and increase rents, especially over the long term. So we're mega bullish on that long term. Short term, we do have to protect ourselves. We have to get a little bit of extra cash into the system. If you found this video helpful, hit that like button, drop your questions and comments below. We want to continue this conversation so that we're all growing together. As always, you can reach us at resg.com, and we are here to help with your local real estate needs, land development, and real estate investing.